It has been said that fintech, which leverages digital technology, is the future of finance globally. And as a financial sector of many economies currently face challenges, the IMF recommends that central banks should formulate policies to guide the usage of fintech in order to maximize the benefits. Tommaso Mancini, Division Chief of the IMF, spoke to Muplang, Dakok, for Business Express in Washington District of Columbia. Let's now join her for that conversation.
Thank you so much for joining us on Business Express on the Nigerian Television Authority from Washington, D.C. I will be talking about fintech, and I'll start by asking you why the IMF is interested in fintech, and then you can tell us the role of the IMF in fintech.
Thank you very much. It's a great pleasure to be here. So the IMF has a mandate to focus on macro-financial stability. And we believe that the developments in fintech have implications for macro-financial stability. The implications are both positive, so there can be large gains in growth, in financial inclusion, in market integration, in cross-border payments, which decreases the costs of doing business. Those are some of the opportunities that lie and that would strengthen the stability of macroeconomics. On the other hand, there are risks to macro-financial stability. There are risks to financial stability. There are risks to the functioning of banks. There are risks to capital flows and capital flow volatility. All sorts of risks that need to be managed, that need to be understood by country authorities. And we are here to help. And we are here to help in our three traditional ways. On the one hand, we do analytical work to try to push the boundaries of our understanding and to help countries come to grips with these new developments. On the other hand, we do surveillance, so we engage directly with country authorities and we discuss policy issues with them in this space. And thirdly, we do a capacity development. So we work with countries to bring our expertise and the expertise of others around the world to help country authorities build capacity, to be in a position to be able to leverage the opportunities and contain the risks of these new developments. We have to establish what success means and what are the criteria with which the central bank and the country has decided to measure the development of the naira. There are multiple reasons why countries engage in central bank digital currencies, CBDC. Naira is an example of that. One reason may be to have a greater resilience in the payment system. So if most of your payments are being intermediated by a private company, perhaps a foreign company, the country is susceptible to that company going bankrupt, deciding to leave the country, running into cybersecurity problems. And having a state-backed means of payment increases the resilience of the system. It adds a backup. Another related reason why countries might engage in CBDC is to discipline the market, to discipline the private sector providers of payments. If there is a public option that is functioning well, that is cheap, the private sector will not be able to charge very high rates and will have to offer good services, even if the public solution is not highly adopted. There are many other reasons. Countries are interested in increasing financial inclusion with CBDC. Countries are interested in encouraging innovation because there can be innovation on top of CBDC. Suppose that your CBDC can be easily incorporated into a digital wallet, into a social messaging app. And through that app, users can have access to other financial services. That would increase innovation. And of course, countries are also interested in leveraging CBDC to facilitate cross-border payments. So Nigeria needs to be very clear as to what its objectives are with the e-Naira, and then success will be measured against those objectives. I have to say that the e-Naira started out with a relatively lukewarm adoption, but adoption has increased tremendously this year alone. And as I understand, usage has increased by about 60% this year alone, and there are about 13 million wallets right now in Nigeria, which is a substantial increase over last year. And surely this will continue increasing as the central bank does more communication, more outreach. And it's important for central banks in general to understand that if they get into this space, which is a new space, it's a space that involves dealing directly with customers. The central bank will have to be more forthright, more outgoing in reaching out to customers and ensuring that everybody understands what this new solution is about.
Okay.
And there are two things that the public authorities need to get right. The first thing is a very clear and robust regulatory framework. So it's important to be clear about what the rules of the game are for the new private sector innovators in this space, whether they're a mobile money provider, a stablecoin provider, a payment or wallet provider. There has to be clear regulation. And that is no small feat. The second thing that is very important in this space is that the public sector continue to play a role in the settlement of transactions. Currently, many of our transactions are no longer in cash, they're in commercial bank money. So you will bank with a specific bank and you will hold deposits in that bank and you will shift those deposits around when you make payments. What is going on under the surface is that there is a public infrastructure to make those payments, and there are central bank reserves that are being moved between commercial banks. And the existence of that infrastructure and the existence of central bank money underpins the entire system and is very important for trust. It brings security to the whole payment space. And it's important that that continue to be so in the world of tomorrow, in the digital world. Central bank digital currency can actually serve that role. Central bank digital currency can be the new settlement asset and the new infrastructure in the digital world of payments of tomorrow. And I would just clarify that digital currency is a relatively large bucket. It would be useful to separate it. And to separate it, we've spoken a lot about central bank digital currency until now. That is the public sector version. And then there are private sector versions of digital money, often referred to as crypto assets. Crypto assets can be backed with assets held in a commercial bank or a custodian. Those are typically called stable coins. And crypto assets can be unbacked, like Bitcoin. So we have very clear policies on both of these areas, whether it's the public sector or the private sector. We've spoken a lot about the public sector, so let me focus on crypto assets and say that the IMF has put out in the end of February a paper that is called the Elements for Effective Policies Regarding Crypto Assets. And what we've tried to do is highlight all the policy objectives that countries should strive to achieve in regulating crypto assets. We believe, first of all, that it's important for countries to retain monetary policy independence. And to do so, it's important that countries not make crypto assets legal tender.
All right, thank you very much once again. Well, that will be all from Washington, D.C., and it's back to you in the studio.
Thank you, Muplang, Dakok.